Hello, I'm Russell Perlman, and this is the Smart Money interview. Today I'm with Mark Travis, and he's the CEO of Intrepid Capital Funds. Mark, thanks for joining us today.
Glad to be here, Russell.
Mark, you run a bunch of funds that kind of can go anywhere and do anything, investing in all types of assets, whether it's bonds or stocks or other things. What's it been like to invest here in this climate where just fear is pervasive, and every day we get at least one piece of bad news, if not 2, 3, or 10 pieces of bad news?
Well, for one, Russell, I've never kept my, I don't have a TV in my office, and I don't keep it tuned to CNBC or any other channel where I hear the pervasive bad news. I think for a longer-term investor, financial assets of all types are attractive. Within the context of Intrepid Capital Funds, our specialties tend to be a smaller to mid-cap equity, where we think there's a discount to private market value, or a less than investment grade credit, or as I like to say in polite company, a higher quality junk bond, where we know we can get repaid with some degree of certainty. But we tend to own what many would consider very mundane businesses that we can value with a high degree of confidence. And we're probably more active in down days than we are in up days as a seller.
You mentioned recently here that you like the high quality junk debt.
Sure.
And you started being a little bit more aggressively buying corporate debt in the fall. Can you tell me a little bit about what was the reasoning why you started buying the corporate debt?
Well, we started our income fund in the summer of '07. At that point, spreads in the prior period, right before Bear Stearns had a problem with their hedge fund, corporate spreads on high yield were only maybe 265 basis points over a comparable treasury. Mm-hmm. Today that spread is somewhere in the high teens. There are a lot of businesses that are not particularly highly levered, in my opinion, mm-hmm. where they maybe have debt equal to 3 to 4 times their pre-tax cash flow, and they cover their interest charges 3 or 4 times over. Businesses that you might recognize like Scholastic that prints the Harry Potter books, or Payless Shoes, with it, you know, it's a shoe store spun out of May department stores, where many times they have cash, they have free cash flow to repay their debt, and we can see how we're going to get repaid, and we're going to earn a double-digit rate of return as a holder of that bond.
So when you're buying the corporate debt, you're not necessarily betting that the profits are going to jump anytime soon, but at least they can cover their interest payments and pay back any loans that they have.
Certainly. Like I like to remind the retail customers out there, you know, the way the capital structure works is senior debt, subordinated debt, preferred equity, and equity, and the food chain goes from top to bottom. So the first people to eat the cash flows are the senior, and the higher up in the capital structure, the better off you are. So in this environment, I'm happy to lend to a reasonable quality corporate credit. I'd also point out, with the index the way it is today and corporate America the way it is today, 51% of corporate credits are less than investment grade. So there are a lot of people by mandate have to own investment grade only. That leaves a big investable universe for us at Intrepid Capital Funds to look at.
Let's talk a little bit about the equity side here, and what looks attractive here now with the Dow and the S&P 500 once again flirting with their lows of the past decade.
Sure. Well, I'm sure it's frustrating for people that have maybe been in the S&P 500 index over the last 10 years that have a negative total return. I'm blessed that that's not where we've been over the last decade as a firm. But I think in particular in the last 6 months, with oil prices dropping pretty precipitously from $147 a barrel in July to I think a recent trade of $35 a barrel, there's some oil service companies and E&P companies that now look attractive to us, whether they are drillers, E&P, or a service company like Tidewater, where their balance sheet is their strength. They're not dependent on the street for financing. And we think using a very conservative discounted cash flow or a comparable transaction, that we can show you why the share price over time will be higher.
You also mentioned that you have a look at a lot at smaller companies and perhaps micro caps. What's their values these days compared to kind of the S&P 500 large companies that a lot of investors normally associate with stocks?
Sure. Well, I think that it's a very inefficient market from my perspective. I don't think it's efficient. I think an environment like this with high fear makes it even more inefficient. Mm-hmm. We have a couple of companies we own today that Benjamin Graham would call net nets, which in essence are saying the market price is less than their working capital. Working capital is current assets minus current liabilities. So we're able to almost buy the business for free if you were to liquidate the business at this price.
That sounds great, and throughout this whole interview, you've talked about seemingly you're pretty excited about being an investment buyer here.
Right.
What out there potentially scares you as an investor right now?
Well, I'm always concerned as I start to leaf my way through a 1,067-page stimulus bill that the heavy hand of government will not let the free market clear itself of its excesses. And you know, the way I would politely describe it is they're not going to allow price discovery to occur. And so the analogy I've used is if you've been to a doctor and you have a cold, and he says, well, Russell, if you'll just go home and rest, you'll be okay in, you know, a week. But if you want, I can give you these tablets and you'll feel better in 2 weeks. You know, I feel like the prescription may be worse than the cold. I don't believe in this close analogy to the Depression. I think, frankly, we have yet to see anything as severe as we saw in 81 or 82 when the misery index, which is a combination of inflation and unemployment, was in the mid-20s. Today, with unemployment in the mid to high 7s and inflation virtually non-existent, I think we are just having to work off some excess leverage, both governmentally and personally.
Great. Well, Mark, thanks so much for joining us today. And you've been watching the Smart Money interview. I'm Russell Perlman. Thanks for watching.